Hi everyone, my name is Richard and today we're going to go over the 12 golden rules of investing and trading outlined by Warren Buffett and taking the key takeaways from every single rule and explaining what it means and how to benefit from these rules. So the first rule is don't time the market. And the takeaway from this is don't think about the market. Look at individual businesses because Warren Buffett says there's limited success in trying to predict the market itself, but it's better to pick businesses or individual stocks. And he specifically says a lot of people have made more money picking businesses to invest in rather than markets.
We don't, Charlie and I don't think about the market, and Ben didn't very much. I think he made a mistake to occasionally try and place a value on it. We look at individual businesses, but the stock market, I know of no one that has been successful at, and really made a lot of money predicting the actions of the market itself. I know a lot of people who have done well picking businesses, and that's what we're hoping to do.
Don't get too attached to your purchasing price. That's golden rule number 2. So what this means is, let's say you pay $100 for a $50 stock, you will feel bad. You pay $10 for a $50 stock, you feel good. Purchasing price doesn't matter in the long run because it just matters if the company is going up, going down, and that's a decision you have to make. If getting attached to your purchasing price can result in you missing important opportunities.
Stock at 50, somebody's paid 100, they feel terrible. Somebody else paid 10, they feel wonderful. All these feelings, and it has no impact whatsoever.
Number 3, don't make aggressive growth predictions. Companies should have realistic growth projections, but many don't. And Warren Buffett specifically said, for example, very few companies can compound earnings to 15%. Only the top upper echelon of the world can even say that their total earnings can even equal close to 15%. So have realistic growth expectations to ensure that your choices are correct.
I think it's a mistake for any company to predict 15% a year growth. There are plenty of them do. Very, very few large companies can compound their earnings at 15%. It isn't going to happen.
Also, number 4, don't use too much leverage. The only way a smart person can lose on investments is through leverage, and Warren Buffett says this. If someone else can pull out for you in crisis, you'll be broke. Like imagine someone had the ability to exit a position for you in the financial crisis in 2008. You would be broke. That's why it's important to trade without leverage or as minimal leverage as possible.
Really, the only way a smart person that's reasonably disciplined in how they look at investments can get in trouble is through leverage. I mean, if somebody else can pull the plug on you during the worst moment of some kind of general financial disaster, you go broke. And Charlie and I both have friends where that's happened to them.
Number 5, don't miss the forest for the tree. The 3 things to get right in choosing a business to invest in, according to Warren Buffett, is the management, the future economics of the business and the industry, and the price. If you get these 3 things right, there's no need to worry about everything, since these 3 factors of a business determine whether it's going to be profitable or not in the future. So if you can just understand these 3 things, there's no need to worry about every little minute detail while investing and choosing a business to invest in.
We've made plenty of mistakes in acquisitions, plenty. The mistakes are always about making an improper assessment of the economic conditions in the future of the industry or the company. They're not a bad lease. They're not a specific labor contract. They're not a questionable patent. Those are not the things that count.
Number 6, do not jump over 7-foot bars. Some businesses are a lot easier to understand than others. That doesn't mean that they're worse to invest in, and a lot of investors tend to make this mistake, and they think that jumping over a so-called 7-foot bar or taking more complicated decisions will give them more money or returns than if you just jump over a 1-foot bar and take the obvious decision, which can sometimes result in just the same or even more profit. And doing this excess work is not always true in the investment market, that you doing more effort or taking more complicated decisions will always result in more profits.
Some businesses are a lot easier to understand than others. And Charlie and I don't like difficult problems. We'd rather multiply by 3 than by pi. It's just easier for us. Some people think that if you jump over a 7-foot bar, that the ribbon they pin on you is going to be worth more money than if you step over a 1-foot bar. And it just isn't true in the investment world at all.
Don't shrink your universe of possibilities. And this is golden rule number 7 as outlined by Warren Buffett. And the takeaway from this is it is a mistake to shrink your universe of possibilities. Don't limit yourself by factors. Warren Buffett clearly mentions that his firm, Berkshire Hathaway, is only limited by size and how much they trade in, the volume that they trade in, not by choice. There's no other factors that limit them from taking decisions. That is something every trader and investor should keep on the back of their mind. Do not limit yourself and be open.
We think the most logical fund is the one we have at Berkshire, where essentially we can do anything that makes sense and are not compelled to do anything that we don't think makes sense. I think it's a mistake to shrink the universe of possibilities. Ours is shrunk simply by size, but we don't set out to circumscribe our actions in any way.
Also, don't stay active all the time. This is rule number 8. People think that they have to invest every day will make a lot of mistakes simply because you're taking a lot more decisions, and you will end up making not enough money to even cover your losses sometimes. So it's better to just wait until a good opportunity presents itself and to jump in on that rather than taking little decisions every day which may or may not go wrong.
If you feel you have to invest every day, you're going to make a lot of mistakes. It isn't that kind of a business. You have to wait till you get the fat pitch.
Also, do not over-diversify. This is rule number 9. Warren Buffett's total portfolio size is $332 billion, but his top 5 stocks compose 80% of his total portfolio. And we can see this, his performance is really, really good. For 1 year, 7.05%. 3 years, it gave 32.60%. And over 5 years, these gave 72.44% in return. So there's no point in always just over-diversifying. That's why. And he says that he knows a lot of people who got their first idea right. They made a lot of money on their first idea, second idea, but he doesn't know a lot of people who made a lot of money on their 7th best idea. So there's no point in over-diversifying too much.
If you really know businesses, you probably shouldn't know more than 6 of them. I mean, if you can identify 6 wonderful businesses, that is all the diversification you need, and you're going to make a lot of money, and I will guarantee you that going into a 7th one is going to, rather than putting more money in your first one, it's got to be a terrible mistake. Very few people have gotten rich on their 7th best idea.
Now, rule number 10, avoid confirmation bias. And this is a really important one, as it's important since humans have a natural tendency to place extra emphasis on information which proves or supports their prior conclusions. And it is something that's very difficult to get rid of. It is a reaction that humans do subconsciously. However, as an investor or a trader, it's important that we weigh all information equally. And don't be unwilling to look at something afresh. To take the right decision sometimes, or the more logical decisions, it's important that we place an equal emphasis on all information in order to avoid taking decisions that can just result in losses by only listening to information or only caring about information which supports your prior conclusions.
There's no question the human mind, that what the human being is best at doing is interpreting all new information so that their prior conclusions remain intact. That is a talent everyone seems to have mastered, and Charlie and I have made big mistakes because, in effect, we have been unwilling to look afresh at something. That happens.
Rule number 11, avoid herd mentality. Humans will continue to make the same mistakes that they have in the past, and they get fearful when others get fearful. When the mass gets greedy, everyone gets greedy. So if you follow the mass, you will fall into the same mistakes that everyone else is making. So don't get caught up with what others are doing. And this is what Warren Buffett mentions, that him and Charlie Munger have an edge over others, because they do not get involved with what others are doing and make their own decisions, which gives them anyways an edge over the herd. So it is something that everyone should learn and follow as a rule.
Humans will continue to make the same mistakes that they have made in the past. I mean, they get fearful when other people are fearful. I mean, but when they get greedy en masse too. I mean, that's where Charlie and I have an edge. We don't have an edge particularly in many other ways, but we are able, perhaps better than most, to not really get caught up with what other people are doing.
The biggest mistakes we made by far are mistakes of omission and not commission. I mean, it's the things I knew enough to do, they were within my circle of competence, and I was sucking my thumb. I probably cost Berkshire at least $5 billion, for example, by sucking my thumb 20 years ago or close to it when Fannie Mae was having some troubles, and we could have bought the whole company for practically nothing.
The final rule, rule number 12, avoid omissions. Do not omit opportunities which you understand well. An example of this is Warren Buffett didn't act on an opportunity of buying Fannie Mae, which resulted in a $5 billion profit loss for Berkshire Hathaway. And we do not want to make the same mistake that Warren Buffett did and learn from it. So if you can see an opportunity, but you understand, well, there is no harm in taking it. Omitting that might actually result in a significant loss or a possible or a probable loss, like Warren Buffett had when he resulted in which he caused a $5 billion profit loss for his firm. So don't make the same mistake. And these are all the 12 rules, golden rules of Warren Buffett. And these are things that you have to watch out for and follow as rules to ensure that you take the best decisions and make the most money over whatever period of time that you trade in. So thank you for watching this video, and I hope you enjoy. And I'll see you next time.